Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. I'm Epstein, and here we are on November 25th, Friday, day after Thanksgiving, 2011. The time getting on just shy of 11 o'clock this afternoon. You know, the gold market tried to get back on a rally note today. Not going to do it. It's acting pretty bad here, down another $8. Silver's down about 70 cents. The copper market's having a lot of problems, too. I'm starting to switch gears, and I'll be doing it for you this week into the March gold, silver, and copper. There's no point in trading diesels anymore. You might as well move over to those other markets. And what's affecting the gold market is the power in the dollar, the weakness in the euro. And I'm going to show you a chart on that. Here it is. Let's take a look at what these three lines are. In gold is gold. The greenback is in green. And the euro currency I've put in blue, miserable blue. You're in the blues. The euro currency is falling, and as it's falling, it is taking the gold market with it to a large degree, and the pressure of the dollar, the rising dollar, is hurting gold as well. And what's taken place is the dollar has become the choice of world reserve currency again. You know, we keep hearing so often that the dollar's doomed and blah, blah, blah. Okay. If that's what you want to think, it's fine. The problem is we don't have to put together how many countries in a Eurozone to get an approval. We don't have to worry about if Germany says yes and France says no. We've got our own situation, and we're big. It's that simple. Yes, China's coming on, and we welcome them. We don't need the burden of the whole world. But when you take a look at this chart, it's pretty evident, I think, at this point, that as the dollar turned itself up, gold turned itself down. Sometimes they travel together, sometimes they don't. It depends what the psychology of the market is. Right now, with the weakening stock market, with the world scared of recession, the people are out there are going to one thing, and they're going to cash. Well, that cash is dollars. Try to get dollars in Europe. You'll see how strong they are. And in order to do it, they're selling what maybe they don't want to sell, but what is the easiest to sell, and it's gold right now, and that's what's on the chart. When I come to this chart, and this is the D's gold, and I'm going to move over to the March next week, you can see that we're getting consolidation against, let's call it the 1700 level, and that's fine. As I blow the chart up, you can see it clear there, and you can see the last rally high was 1710.80. Now, if you can get over that number, you could make an argument, if you don't get down to 1667.10 first, that the market has lows that are higher and a high that would be higher. That would be good news. So in other words, the key is not to take out 1667.10 and to get over 1710.80 if you're going to start anything bullish. But right now, that's not in the cards. Right now, what's in the cards is that the market is still making the lower highs and lower lows. This red line here is the July 31st closing price. That number 2170. It's in very small print over here, but it gives you an idea of what I'm looking at. And one of the plays that I look at each year is where will the market finish up December in comparison to that July 31st price. And in bull years, I look for it to gain on it. Only, in fact, 1 year, 2008, in the recent 10 years, has it not done so. And it doesn't look to me like it's going to be a big gain unless something happens sharp in terms of world problems that we don't know about. Gold is under liquidation. It's not under accumulation. Now, the most interesting part of that statement is I'm wrong in making that statement if you look what central banks are doing. They are accumulating. Wednesday there was a report on what central banks are doing. They're the ones buying this gold, and I think they're right on the money. Sooner or later, somebody's going to say they're going to a gold standard. It's going to happen over time here, and I think gold is that surprise market. The 18-day, the 45, and the 100-day averages. For days I've been telling you that we're getting finally, the market's all coming together, and this 18-day is going to start dropping very sharp. You know that because of how the patterns have gone, and you're losing these days back here. So now the past 18 are going to drop some of these earlier days, and they're going to have more of these. And that number is going to start coming down at you, and they're going to converge. What's holding the market is the Bollinger Band. Now, the black lines, this is part of what's called an algorithm, a Bollinger Band theory developed by John Bollinger. And the simplistic way to look at it is that the market trades within the bands 95% of the time. And when the market gets a strong trend, it tries to ride a band. In this case, it's trying to ride the bearish band. Only 2.5% of the time does the market stay under the band. So flip-flopping to the other side is one thing, but as long as you're making lower highs, you're still in the bear phase. Let's assume you took out 1710.80. You'd still be under the 18-day average of closes. So the best I could look for if I were a rip-roaring bull is a short covering rally. That's about it. I don't see a reason to even think of getting long gold just yet. You can see this when I add the momentum study to it, that the gold is oversold, and you can see how it's riding this Bollinger Band. There's just nothing here that's friendly as I'm seeing it. The silver market's not far away from that. The silver market's making the lower highs. I don't know where this current break is going to end. We know where these past lows were, and we know that once the market got a couple of days of trading under it, it flip-flopped to the other side of the Bollinger Band, but it's not getting away from it. Still very bearish situation. In the platinum market, it's identical. Liquidation phase, dropping away, but oversold. So the one thing I can tell you about all the currents, all the metal markets, they are all in oversold territory, but they've all got bearish chart formations. Let's come here to the, in fact, I don't even want to cover that one. I want to cover the OJ. I'm looking for markets that are responding favorably right now to what's going on. With all the bad, this orange juice market out of left field came and went from the 166 area to 181 just out of nowhere all of a sudden. You know, you always look for markets that are bucking the trend because so many commodity markets have been down. This morning, I know I woke up and I was looking at the Dow when it was down in the 11,128 zone, and it's come back, but this is a holiday-type market. It's very thin. If I had to tell you to focus on anything that you're seeing a change happening, it's the U.S. bonds and notes. They're rolling over. I don't know why, other than maybe people think things in America are going to get better and higher interest rates might at some point be coming on. There's certainly some of the risk premium of Europe coming out of these markets today, and I found that very, very interesting. In any case, it is...